Hello, and welcome to today's webcast, The Case for Gold, sponsored by Sprott Asset Management. Today's live webcast has been accepted for 1 CFP, 1 CMA, and 1 CFA CE credit. For questions on credit, please use the number on your console. Additional documents can be found in the green folder at the bottom of your screen. We also have a brief survey, which can be accessed from the teal folder. Our speakers will be taking advisor questions. Please type your questions in the box to the right of the slides. We'll get to as many of your questions as possible. If you're interested in a one-on-one meeting with Sprott Asset Management, please click the blue one-on-one folder at the bottom of your screen and confirm the request. A replay of this webcast will be made available. All registrants will receive replay information by email. With that, I'd like to turn it over to today's first speaker, Ed Coyne, Exec Vice President with National Sales at Sprott Asset Management. Ed?
Thank you. Again, my name is Ed Coyne. I head up National Sales at Sprott Asset Management. For those that aren't familiar with Sprott, Sprott's a global asset manager providing investors with access to highly differentiated precious metals and real assets investment strategies. At Sprott, we offer a full suite of solutions from our physical gold and silver trust and factor-based junior and senior mining ETFs to private equity, credit, and debt. With me today is John Davey, founder and CIO of Astoria Portfolio Advisors, and Sri Karkagard, portfolio manager from Sprott Asset Management. John Davey has over 19 years of experience spanning across macro ETF strategy, quantitative research, and equity derivatives. John has spent 8 years as head of Morgan Stanley's institutional ETF content, where he advised many of the world's leading investment management firms in quantitative ETF portfolio construction and implementation. John spent 10 years at Merrill Lynch as an equity derivatives and quantitative strategist, and in 2017, John founded Astoria Portfolio Advisors. Sri joins us and began his career at Sprott Asset Management in May of 2010. During his time at Sprott, Sri has run both long-only and long-short strategies. Sri specializes in precious metals and commodity investing. He also leverages his experience in derivatives across various mandates and implements strategies for risk mitigation, income generation, and improving upside capture. The goal of today's call is to really talk about the tale of two allocations. We're going to take an inside look at how an advisor and a portfolio manager view gold and gold equities when constructing a well-diversified portfolio. John, I'd like to start with you. We were talking about this before the call, actually. I think it's an interesting topic to kick off this webcast with, which is U.S. equities are hitting all-time highs in both total return as well as duration of the current bull run. Why should an advisor or a capital allocator consider gold and silver as part of their allocation?
Sure. Thanks for having me, Ed. So just to kind of level set the conversation, first, we're actually not financial advisors at Astoria, so we are an investment manager that designs ETF portfolios on behalf of other advisors. And, we kind of view ourselves as more of like a portfolio construction, research firm that does a lot of sub-advisory work with our partner clients. And just full disclosure, we're not bears, we're not gold bugs. We actually have a fair amount of risk in the portfolio at the current moment. But, if I could just take a step back. So I've been designing portfolios, doing research, and I actually started working with ETFs in 2000. I was the ETF analyst with the Merrill Lynch's quantitative derivative research group. So very familiar with ETFs. Let me talk about the Fed, the economy, the cycle. Everyone obsesses over the word the cycle and kind of where we're in the cycle. I think there's a disconnect between the business cycle and the stock market cycle. Usually there's a linkage between the two, and there should be a linkage. But, let's face it. I mean, there was a massive put that was provided to the marketplace by the three major central banks, and that inflated financial assets tremendously. And, that's not unusual. I mean, if you follow the work of, let's say, Ray Dalio, he's written books about this, YouTube videos, cartoons. This is what he's been writing a lot about is kind of the behavior of cycles and how what the Fed has done recently is no different from what they've done in the past. So look, we're in a new cycle for the stock market, in my view. I mean, that put that was provided to the marketplace is in the process of being unwound. If you look year to date, S&P has outperformed EEM by 22%. So our big picture views in terms of how we construct portfolios, why we look at commodities, why we look at gold, is the following. One is this cycle, as I mentioned, where there's a differentiation between the business cycle, which is great, and the stock market, which I think is a lot more vulnerable. That's the first kind of big picture trend. Second, inflation's rising. I don't think you need to be an economist to realize that prices are higher. Anywhere you look in the country, if you just travel, you see that prices are elevated. If you look at the New York Fed inflation gauge index, it's been hitting multi-year highs. Rates are obviously rising, particularly, in the last, week in September, the first, couple days here in October as we're doing this call. And that's a function of the economy being very strong. Corporate profits are soaring. We wrote a report recently basically saying, ignore the Fed and focus on the big picture. I've been working 20 years in this industry, and the Fed has always been behind the curve. I don't think this time is any different. 10 out of the past 13 hiking cycles have led to recession. Will this time be any different? I don't know, which is part of the reason why we want to have, gold in a portfolio to kind of hedge uncertainty, to hedge higher inflation. Look, you can't time the market, okay? The biggest and the best on Wall Street don't do it on a repeatable, systematic basis. So what makes you think that you will be able to do it? So our vantage point is that, when inflation rising, uncertainty rising, we don't think that it's a bad time to own some gold in a portfolio. So our overarching investment view is to overweight equities, massively underweight bonds. We think bonds are a huge bubble. Whatever bonds we own in our portfolio is rate hedged, it's very short duration, floating rate structures. We were very vocal about owning commodities. I did a Bloomberg panel in December of 2017. I said own commodities. People looked at me, they laughed. Bitcoin was going to the moon. S&P had a 4 Sharpe ratio in 2017. So we were very early with that call. And our point for including commodities is that, it's a play in inflation. It's a late cycle play. It's a hedge against inflation. I think commodities are very, very cheap. And, there's a lot of commodities actually giving you positive carry. And then another aspect is that commodities provide positive skewness, right? So, there's a bad corn season, bad corn crop, corn prices explode to the upside, let's say. So we like commodities quite a bit. I've been around a few cycles. I saw in 2008 the world was falling apart, and crude oil futures literally went up 150% in 2008. So kind of commodities, my point is that, it operates to its own beat. So this year, 2018, you're starting to see a lot of interesting trends. Liquidity sensitive assets are basically in a bear market. Cryptocurrencies are down 75%. Emerging market debt is getting destroyed. Emerging market equities are in a bear market. Anything that's a function of liquidity is in a massive bear market. So I think that means that the market is telling you something. So from our vantage point, the bull case on gold for at least owning some of it in the portfolio is that, it diversifies your stock, your bond allocation. There is some seasonality for owning gold. I'm sure Sheree will go into a little bit on this, but Q4, January historically been a really good seasonal positive performance for gold. Obviously, September, October has been weakness for stocks. I think there's some year-end tax trades that happen as well that makes it bullish for gold. So, the bear case is that, look, 10-year real rates are rising very strongly, right? You've got, just in the last 5 weeks, 10-year real yields have gone from 70 to 104 bips. So I don't want to paint a complete rosy picture for gold because there is a real opportunity cost for owning it at this point in time. So let me pause there, Ed, and kind of give it back to you. But that's our overarching view about the Fed, the economy, what we think about the world, and why we own some gold in our portfolios.
Sure. Thank you, John. And I think that's a great point, too, because talking about an opportunity cost standpoint, talking about it as not having it be just a static weight in your portfolio, but be mindful of what's going on in the broader market makes a lot of sense. And I think gold really has moved into sort of the modern era of investing, and people investing in gold and even gold equities to some degree as really more of a true alternative and not just the world's coming to an end and you own some gold mentality. So I think the way you're applying it in your portfolio, we're experiencing ourselves, more and more advisors and institutions are thinking about it in those terms. Sheree, I'd love to shift gears to you a bit and dive a little deeper into really both gold and silver. You recently published a report that we'd be happy to share with the listeners today, back in August, titled Buying Opportunity as Gold and Silver Shorts Reach Record Levels. Can you touch on that a bit and talk about why these record levels of shorts are potentially creating opportunities in today's market? What is that really saying to the market right now that shorts are so high in both gold and silver?
Sure. So the CFT publishes every week a data point that allows investors to get a gauge on where speculators as well as commercial producers of gold and silver stand in terms of their positioning. And currently we're at a point where speculative short interest in both gold and silver are near record levels. They're at levels, and they've actually persisted at those levels for almost a month now. What we have seen previously is that when speculators are positioned towards one extreme or the other, so if they're extremely positioned on the bullish side or on the bearish side, that tends to mark in the short to medium term a low or a high. It tends to be very coincident. So right now, with the record levels of short prevalent both in gold and silver, what it's telling us right here is that the investor sentiment is not only negative, but it is very stretched towards the negative end. And any sort of short covering that will come out of here will likely lead to a relatively quick bounce in both gold and silver. The other thing that is also worth noting here is actually one needs to put the level of short for both gold and silver into context in terms of what sort of size are we looking at. Silver in particular is at an extreme in a sense that there are currently over 510 million ounces of silver that have been shorted by speculators, and the total annual production of silver from silver mines tends to be around 900 million ounces a year. So well north of 50% of the annual production of silver is currently short. And to put this into a different context, silver currently, as per the Silver Institute, is in a net deficit scenario. So with the demand for silver, and demand for silver is primarily coming from industrial uses, and in particular solar panels. They have been soaking up all the silver. Very little silver actually gets stored above ground by investors. The little bit that does is usually kept in form of coins and bars, but most of the silver ends up in industrial uses. And when you have a scenario where more than 50% of a metal, which is in a net deficit scenario, being shorted by speculators, it really is something worth paying very close attention to. So I think there is a tremendous amount of opportunity in silver. The same goes for gold. So the total amount of gold shorts right now are 21 million ounces. And in terms of the global production, it is a sizable amount. And especially when you take away the production out of Russia and China, both of those countries, China is the biggest producer of gold, and you cannot export gold out of China. Russia is among the top 5 producers of gold, and most of the gold that is produced in Russia ends up being purchased by the Russian government. So we are looking at scenario both in gold and silver, which we have not ever witnessed before, and for that reason, I think we're looking at some very interesting opportunities. it just so happens that both gold and silver over the past 5 years have really been trading in a bit of a range. So for gold, for example, the range has been $1,100 on the bottom, $1,400 on the top. We're closer to the bottom than we are to the top right now, and we are also extremely stretched on the short side. So I think this is the reason why I think we are seeing a very good opportunity to be positioned on the long end for gold as well as silver here.
Great, thank you. And I'm always surprised that 100 seems to be sort of the new baseline for gold. And you look at all the things that are going on, and equity markets continue to do well, although today they're off a bit. I think it's fascinating to me from a bullish standpoint that gold is really kind of hanging in there, as it were. And same with silver, that $14 to $15 range. I think there's a compelling argument there. I'd like to shift back to John for a second on this, because I think it's an interesting point that we're at sort of a stretched moment in time. Now, John, you're very practical about constructing the ETF portfolio. You're not necessarily chasing a price move day in, day out. You're really looking at it more as a true diversifier in a portfolio. And by constructing a portfolio with a basket of predominantly ETFs, do you have a sort of a static or fixed percent that you like to think about with your gold allocation, or you're letting the market sort of dictate that? I know in the past we've talked about it and it's maybe moved around a bit. So maybe help people think about, how you think about your gold allocation relative to what's going on in the market and what those percentages typically look like.
Sure. So if you take a step back, this concept of a 60-40 portfolio, and let's just say, international stocks, ACWI, versus the U.S. aggregate bond index. That's typically, that's certainly our benchmark, and I think that's fairly common in terms of what similar firms like us use as their benchmark. But if you stuck with a 60-40 ACWI Ag benchmark, the equity side of the portfolio would make up about 98% of the total portfolio risk, right? Which is obviously substantial, right? Because stocks are much more volatile than bonds, right? Stocks inherently have leverage, they have a lot of debt. So if you just took 10% from the equity side, right, and added that to gold, right? So you did a 50-40-10 ACWI Ag and a gold ETF. You would reduce the equity risk contribution from 98% to approximately 83%. So, that's fairly substantial. I think rule of thumb, people have said, okay, you should always own, somewhere between 5 to 10% gold in your portfolio. If you're not trying to be a market timer, we've kind of had that range, in the last, kind of year, year and a half. When markets were stronger as they were last year, we kind of were on the lower band. I think right now, in particular, where real yields spiking higher pretty significantly, there is more of a risk for equities to kind of roll over. So, we would kind of tactically shift that up a bit, and particularly with the seasonality between, September, October equity weakness, positive for gold, and then kind of early Q1, January tends to be kind of a positive month for gold as well. So, we're tactical ETF managers, so that's kind of our range, somewhere between, 3-5% on the low end to, closer to 10%. We had an outright gold position in our portfolio. We currently have an outright gold ETF position in our portfolio, and then we also allocate to like a broad-based commodity ETF, of which is a function of energy, oil, agriculture, and metals, so platinum, gold, and silver and whatnot. So we have actually a little bit more gold via the broad-based commodity ETF. So just to summarize, you want to think of things in terms of portfolio risk contribution, and gold kind of acts as a diversifier for obviously both stocks and bonds.
Thank you. And Shri, let's go back to you for a moment, because, as a portfolio manager in the precious metal market, you're required to have a permanent allocation. And you clearly go beyond just allocation to the physical metal. You're looking at both equities, you're looking at other vehicles and structures that are in and around the gold trade. How do you think about that from an equity standpoint? When people talk about gold equities in general, they talk about it predominantly as a levered trade to the price of the metal itself. But as a portfolio manager looking at individual securities, clearly company balance sheets matter, strength of management matters, maybe the location of the mines actually matter. Walk us through that shift from thinking about gold and silver as an allocation as the base metal or the core metal, precious metal side of it, to making that transition into the equity side of it. What's important to you, and how do you look at that regardless of where we are in the market cycle?
Sure. So when it comes to market cycles, as John was saying, it's very difficult to time the markets, but it is relatively simple to understand what kind of a market someone is in. So, for example, in the early 2000s to, I would say, about 2011, we're in a bull market cycle. Currently, we're in a bear market cycle, hopefully looking to transition out of that and into a bull market cycle. But knowing what the prevailing sort of sentiment and conditions are is very important. So knowing that we're in a bearish scenario where the cost of capital for companies is relatively high, access to the capital markets is relatively tight, there's not that much capital flowing into this space right now, it is very important for a portfolio manager to be cognizant of that and also maintain the portfolio in a way that the key thing that you're trying to accomplish is to protect and preserve investor capital. So the way that we go about doing that is by positioning in companies that are, first of all, producers. So our portfolio tends to be tilted towards producers, and producers with very robust margins, high levels of free cash flow yield per share, as well as the ability to internally fund their growth projects. All of these things are very important because, as I said before, capital is very scarce during bear market cycles, such as the one we're in right now. And what we have seen is that companies that have the ability of maintaining profitable operations, these companies have been able to significantly outperform their index, which in turn has allowed them to contribute positively towards the portfolio and add a significant amount of alpha to our portfolios. Now, inversely, when a bull market phase is upon us, and it doesn't take a genius to figure out when we are in a bullish phase because metal prices are going higher, cost of capital is starting to move lower. You start to see a lot of deals being done. You start to see a lot of new money flowing into exploration companies, development companies, especially because investors are anticipating higher metal prices. And when you are in that sort of a cycle, then the job for us is to reduce our exposure into producers, not in a significant manner, mind you, but reduce the exposure from producers and more into the exploration companies, because that is really where you get the biggest bang for your buck, as these exploration companies are able to outline new projects, which in turn generates lots of additional excitement and also brings into picture the M&A activity as majors look to scoop up these new exploration stories for their potential upside. So that's, in a nutshell, that's kind of how we look at things from a market cycle perspective. I think you also asked about how we look at the companies from a perspective of balance sheet strength, strength of the management team, as well as I think location of the mines. And it is absolutely these are three very important considerations for us. The quality of the balance sheet is probably, I would say, if I were to rank things from 1, 2, and 3, I'd probably put the strength of the management team as being paramount. I'd rank that highest because we have seen good management teams and great management teams take marginal assets or subpar assets and really make them more efficient, and which in turn drives profitability in the operations, and that drives value for shareholders. Whereas we have seen management, which would be considered subpar, take perfectly good assets and figure out very innovative and interesting ways of really pampering those assets by doing really terrible deals, such as selling royalties or getting into the wrong sort of a joint venture. And there's many different ways of doing that, obviously. So management team is the single most important focus for us. The strength of the balance sheet is very important as well. I would say it's the second most important thing, because having a good balance sheet obviously allows a company a huge amount of flexibility in terms of how they time their growth going forward, what they can do from an M&A perspective. So it creates a lot of flexibility, lots of breathing room for a company if they have one or two quarters where operations are not progressing along the same path that they had initially anticipated. The location of the mines is probably, I would say, number 3, because in general we have seen the market do a relatively good job at discounting companies based on the location of their projects. So if a company has a project in Congo, for example, or other challenging areas like Russia or other jurisdictions, for example, the companies typically don't trade at the same valuations as a company that may have a project in a tier 1 jurisdiction, such as Canada, the U.S., or Australia, for example. And so generally the location of mines is relatively well discounted. So that is, I would say, rank that as number 3 in the level of importance for us. The thing that is the more important factor for us here is to actually keep a finger on the changes that are occurring on the ground at these projects, because there have been times where perhaps the social situation changes or the political situation changes on the ground. Those are very important factors to keep in mind, and it does not even have to be country specific. It could be specific to a particular province or a state in a country. But those are the kind of things that we keep a much closer eye on, and being able to stay ahead of the curve there does provide relatively good sort of dividends for our investors, as far as creating the right kind of returns by investing in the right sort of locations that way.
And John, you may want to add to that as well, because I know you've largely talked about allocating just to the med cells. Do you have any view, or how do you think about the equities?
Good question. Currently right now, we're just allocating to the gold bullion itself, but in years past, I think there was a fairly attractive setup for the gold equities, and they did fairly well in years prior. I just want to make a point. Sheree said something really interesting in terms of the market cycle and the cycle for gold and bullish bearish. I remember in 2008, the gold ETF had something like $80 billion in assets, and SPY ETF had only at the time like $50 billion in assets. That was literally 2008, and that was a function of that. At the time, I had been working at Merrill Lynch, and obviously, the last hour we were acquired, and I think my personal account, I had like 50% of my personal account in gold, and that obviously is the top, right? You should never have that much in gold relative to equities, right? Gold is a income producing asset. It's a storage of value. The value is worth based on what people kind of determine the market clearing price is. Do I think we're closer to coming out of the bear market? For gold, which we've been in for quite some time, I would say that there's a relatively higher probability. The key is that we're in a period where real rates are rising, and they're rising rapidly, so there is a strong opportunity cost. And investors didn't, you were getting no cash at the bank for most of the post-credit crisis period from 2009 to 2017. But we've had something like 8 rate hikes. And now you're starting to get, cash. So I think that's what is a bit of an issue for those that want to look at gold going forward. But, I still stick with, having a portion of it because, inflation's rising, and typically when inflation rises, gold historically has done well.
Yeah, and you touched on this, as has Sri, about the landscape itself. I like to always think about really pre-2000 versus post-2000. And I really think of, we'll call it the late 90s even, into 2000 is gold really entering the modern era of investing with mutual funds, closed-end trusts, and even now today with ETFs. It's a much more liquid investment today than it was, say, 20 years ago. It's very difficult to invest in the physical metal. But let's just touch on that for a second, because you've really built your business around ETFs, right? And I think we'll shift away from gold specifically for a moment and really talk about the structure of ETFs and your experiences. What are some of the huge benefits of investing in an ETF, which some people know about, but it'd be interesting to hear from you on that. And then what are some things that people should be aware of from a risk standpoint of investing in ETFs versus owning a individual stock or a mutual fund? If you could touch on that for a moment, I think that would be helpful, and I think it's timely given the landscape we're talking about right now and how gold has moved into sort of that modern era through different types of vehicles.
Sure. So very bullish on ETFs. Basically started a firm that devotes their entire resources to building portfolios of ETFs. I started my career as equity derivative research analyst, and we covered ETFs, and we were building ETF portfolios for other institutional clients. So I've seen the gamut. It's a superior vehicle, in my opinion, compared to, let's say, mutual funds. Doesn't mean that there's not a place for mutual funds in a portfolio, but if you think about ETFs, they're cheap, liquid, very tax efficient. You could do tax loss harvesting transactions with ETFs, which you just can't do that with stocks and obviously with mutual funds. You can get exposure to multiple different asset classes. So in our main fund, multi-asset risk strategy, we have 5 or 6 asset classes in there, everything from, U.S. stocks, international stocks. We have exposure to, convertible bonds. We have exposure to senior loans. These are things that, 10 years ago you just couldn't do, right? So it's a very, frankly, if I wanted to start this firm 10 years ago, it would have been a very different scenario, because it would have been a lot more difficult to get exposure to all these asset classes. I think the daily liquidity is nice. It's not, kind of necessary for, more than half the ETFs out there. Most of the ETFs out there are buy and hold, so they probably would have been better in a mutual fund structure. So, I think mutual funds probably needed to come down on fees and maybe kind of work with the regulators on changing the tax inefficiency of mutual funds just so they wouldn't lose as much market share. So, that's what our firm does. Just to go back one quick second, I
Sure.
completely forgot about this. I can't believe we haven't talked about this, but, one positive thing about gold relative to, let's say, the cryptocurrency space is that, you've got 2,000 cryptocurrencies, coins. I think that's very bullish for gold, is that, cryptocurrencies have, kind of fallen anywhere between 50 to 75%. Whereas gold, there's just one kind of gold, right? You've got gold and silver, different applications between the two, but I think that bodes well for gold as an asset class. So I just wanted to kind of throw that in there. But, obviously we're very bullish on ETFs. It's a superior vehicle, and, owning, kind of commodity-based ETFs, in particular, once you go away from gold and you've got to deal with the futures market, it's just a lot easier to kind of own a commodity ETF.
Mm-hmm. And, it's funny you said that about cryptocurrencies. One of our portfolio managers, Trey Reich, always likes to say that, cryptos are regulated by the laws of math, right? You can sort of dial them up, dial them down. Yeah, there's limited supply, but you can fork them and do all these different things with them to create additional supply. And there's thousands of them out there, right, as far as the number of coins, where gold is really the laws of science, right? Even when gold was peaking, the total ounces mined every year remained largely unchanged. It's already a 24/7 cycle. So I agree. It's a true limited commodity that's out there from a pricing standpoint. I think that is an interesting point to make. Sri, to that point on ETFs, as a portfolio manager where you're constructing a portfolio, you've got allocation to the physical metals, you've got allocation to the equities. Do ETFs from a PM standpoint, do they fit into your portfolio at all? Do you look at those from a product standpoint at all? And if so, maybe explain that a little bit as far as how you view ETFs when you're constructing a portfolio, if you do.
Mm-hmm. So as a portfolio manager whose job is to invest, or rather invest in equities in order to outperform the index, it is very difficult for us to outperform the index by buying the index. So we obviously cannot be buying the ETFs on a regular basis. However, I mean, that's not to say that we don't use ETFs. So, for example, from time to time, when valuations start to become a little bit rich, or we become uncomfortable about the investor positioning in the space, we will sometimes dial back our exposure and raise some cash. And when the time comes to reallocate the cash back into the space, if we are having trouble uncovering opportunities, or we have to allocate a certain amount of cash in a hurry, we'll oftentimes do so by using the ETFs as a proxy, and then or a short period of time we transition away from the ETFs and into individual equities. So, I mean, long answer short, we do use ETFs, but on a very, very short-term sort of a basis.
Okay, great. Well, as we're sort of wrapping up the more formal part of the presentation, I do want to leave some time for some Q&A. But before I do that, I think it would be helpful, and I think you both sort of touched on it a little bit as far as bullish or bearish cases, both on the equity side, the bond side, and the precious metal side. But I would like to get, sort of from both of you, really your near-term outlooks on the overall market, more specifically to gold and silver, and then where you're seeing potentially opportunities going into 2019, and any potential risks that may be lurking out there in the market. So, John, it'd be helpful to hear from you as I understand it correctly, you're in the process right now of sort of rebalancing. What are you thinking in the near term, and what are sort of your outlook for 2019 from an overall market standpoint?
Sure. So, we had a report last week basically saying, ignore the Fed, focus on the big picture. And the big picture is that, inflation is rising, rates are rising, and I think we're in a period where, there's this transition away from, embedded put to the marketplace. We also have pretty significant divergence in global growth between U.S. kind of leading the world, from GDP standpoint as well as earnings standpoint. Tactically, I think next 3 months, my guess and my sense is that U.S. probably underperforms the rest of the world. You get a little bit of rotation away from growth to value. I think bonds will continue to struggle. We've been pretty bearish on bonds for most of this year. We've been largely ignoring it. We like commodities. I think that's still very, very attractive in a portfolio, given that, inflation's rising. I think people are already loaded up on bonds. There's been over $2.5 trillion of inflows into bond funds since 2009. I think U.S. equities and the equity fund flow story is kind of largely played out. So if people are looking to kind of allocate away from stocks and bonds, there's not too many asset classes they can go into. So I think, commodities, we like them very much. We actually have increased our commodity exposure recently. And I think, tactically gold in the next few months, provided that real rates don't continue to spike up dramatically, which they have in the last 5 weeks, as I mentioned earlier, I think, there's a tactical case for owning gold on a short-term basis, the next couple months.
And Sri, you may want to add to that as well. From your point of view, you're always looking out at what's going on in the short term, but also longer term, particularly into 2019. John talked a lot about opportunity costs, that's something I focus on a lot right now also with rising rates. There's a potential risk in precious metals through opportunity costs of not having that capital used elsewhere. Maybe focus on that for a moment. Just talk a little bit about 2019 as we wrap up this year, and then the next 80, 90 days. What are your outlook for 2019 from a risk standpoint, but also from an opportunity standpoint? What are you seeing out there specifically as it relates to gold and silver?
Sure. So John touched on a very important point, which is rising interest rates. So you're starting to see interest rates rise both in continental U.S. as well as abroad. And at the same time that the economy continues to do well, you're starting to have inflation starting to get reintroduced back into the economy. And these are the kind of things that you start to see when during the later stages of the economic cycle. Now, I'm not really out here trying to call a top in the market, but one of the things, and when I started at Sprott, I joined as a small cap analyst, and I spent the first few years looking at all sorts of different sectors as a small cap analyst. And one of the most important input that goes into valuing a company is the discount rate. And with interest rates rising, it is very natural that the discount rate rises as well in order to come up with a valuation for the company. So with the Fed put that existed for a long time ago, the accommodative language is now out of the Fed communique. You're starting to see similar sort of developments occur in Europe as well. So what that leads me to think is that we probably have seen the high on the PE multiples for the market. Not necessarily the price of the S&P, for example, but definitely the price to earnings multiples, price to cash flow multiples. I think we're probably at the high point right now. We probably past that high right now because we're starting to come lower. And as far as the opportunities that I see in gold, silver, and other various commodities, I mean, I'm in agreement with John right here as well, because the late stages of the economy, as John touched on very early in the podcast, he did mention that the Fed is typically behind the 8 ball. And this time probably won't be any different, which tells me that we'll probably get one of those overheating style type of moves in the economy where all the commodities do really well, and we probably start to see the economy continue to do well, but the stocks beginning to struggle a little bit. So I think looking out into 2019, it will be very interesting to see if the reintroduction of inflation back into the economy is able to benefit gold and silver. We have been range bound for the past 5 years, and if we were to see gold move past the $1,400 level, that would be telling me that we have finally kind of moved beyond the bear market and hopefully are transitioning into a bull market. So that is the development that I would like to see in 2019 and that I hope to see.
Yeah, I agree with Shri. I mean, Fed needs to be really careful here, right? Because they can't go higher and faster than what's priced into the forward curves. If they do, huge policy, huge potential for policy error. And, we've seen this movie before. 10 out of the last 13 hiking cycles have led to a recession. We're not calling for a recession. Like I've never seen anyone kind of being able to forecast recessions, even though every single sell-side firm now has a recession checklist. Where were those recession checklists in 2008? I don't know. I didn't see one back in 2008, but everyone seems to have one now. So, the Fed needs to be careful, in my personal opinion, and I would argue they're probably closer to ending the rate hiking cycle than continuing further. So.
Okay, great.
And the one point that I quickly want to add right here is, and something I should have mentioned well before, and I have no idea why I did not bring it up. Oftentimes people look at gold and they say that if the Fed is increasing the interest rates, gold will not do well. Well, the Fed began hiking interest rates at the end of 2015, which just so happened was also the low in gold. And right now we're talking at gold, which is now over $100 higher than its low in late 2015, 8 hikes later. So the Fed interest rate policy and gold itself are not that closely tied as people think they are.
Yeah, to that point, Shri, I think, back in 04 to 06 when the Fed raised rates 17 consecutive times, over that time frame, I believe gold was up over or close to 80%.
That's right.
What's interesting is, people always talk about the direction of rates. The reality more is the why behind that rate, right? And not that we're calling for recession, but the Fed clearly needs to get rates up so they have some ammunition in their barrel, so to speak, if we do find ourselves in a recession down the road. So, rising rates isn't necessarily a death nail for gold and precious metals in general. In fact, historically, it's actually been positive because they've been raising it, or rising rates, to sort of get ready for the next potential issue. So I don't think that's necessarily a bad thing. At this time, I'd like to turn it back over to Natalie because we'd like to go into the Q&A session. And we did have a couple questions come in at time of registration, and I'll be happy to read those off. But Natalie, I'll turn it back to you.
Great. Thank you all so much for such an informative presentation. As a reminder, additional documents can be found in the green folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey located in the teal folder. Our speakers will be taking advisor questions. Please type your question in the box to the right of the slides. We'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Sprott Asset Management team will reach out to you directly. We also have a one-on-one meeting request located in the blue folder, also at the bottom of the screen, in case you'd like to have a conversation to further discuss the ideas that were covered during today's event. With that, let's take our first question.
Great, thank you. This is one that actually ended during registration, and I think this is one that few people really focus on unless they're truly into the precious metals trade. But over long periods of time, gold and silver ratio has been around 60 to 1. Recently, it's jumped above 80 to 1. What do you all make of that? And Sri or John can answer that. Sri, you want to take a stab at that, or?
Sure, I'd be happy to take a stab at that. So the ratio between gold and silver, I mean, many people have many different opinions about this, and the bulls on silver will point to the historical ratio, which used to be around 16 to 1 or 17 to 1, and say that is where the ratio should go to. And right now we have a ratio of 80 to 1, and the only thing that it tells me right now is that gold is relatively more expensive than silver. But that really is not the big question here. When we're trying to answer as to why it is right here, the why is more important here. What we have seen over the past, I would say, 3 or 4 years in particular, is that gold has been under pressure, but at the same time, you've seen as the global economies kind of come around, the cost of copper has increased, the cost of nickel has increased, the cost of most base metals has increased. Now, many of the listeners probably know, some may not, and the fact that silver is not mined as a primary metal. Silver is primarily mined as a secondary metal, along with other base metals. So most of the silver, I think it's close to 70% of the silver, is actually extracted as a byproduct from nickel mining, from lead mining, zinc mining, what have you. So as a result of what a lot of the producers end up doing is that they will oftentimes forward sell the silver, they will short the silver and lock in the price that they're getting on the silver. And they're happy doing so because it helps them reduce the cost that they report to the investors for mining their copper or nickel or what have you. So for this reason, because the base metal prices have been doing really well, the miners have responded by trying to lift their output of the base metals, and they've shorted more of the silver on the other side. Obviously, that cannot keep going on for a very long period of time, but that is where things have led us today. And I think that's probably one of the most important reasons why we have silver trading at the ratio of 80 to 1 compared to gold. And on the flip side, gold is not mined as a secondary metal. In fact, I think closer to 80% of gold mining is done on a primary basis. So as a result, gold prices and gold production is a little bit more elastic together. So if gold prices are moving lower, gold production moves lower. If you start to see base metal prices come under pressure, then it is likely to see silver prices respond higher on the back of that. Until you see that, you probably will not see the ratio go back to 40 to 1 or 50 to 1 or some other bullish cases. The other time where I think the ratio can compress would be if we get a big run in gold, because people then start to look at silver as a cheaper alternative to gold, and the investment demand for silver rises as a result. If and when that were to occur, we'll probably see the ratio start to compress back again.
Excellent. Thank you. And John, actually, this question just came in. This is specific to a comment you had made earlier, talking about ETFs and how you build portfolios. In constructing those portfolios, how important is the daily liquidity in an ETF that you're considering?
Good question. I think, so I sat in the ETF trading desk at Morgan Stanley writing ETF content and working with institutional fund managers and hedge funds, not retail, I want to make that point, not financial advisors, but, the stat at the time when I worked there was something like, of the 2,000 ETFs out there, the top 100 were responsible for like 80% of the aggregate secondary market liquidity. What I'm trying to make the point is that I think the liquidity aspect of it, while it's good, the vast majority of the ETF assets out there are kind of buy and hold. So I think the daily liquidity is a bit over-exaggerated. To be honest, most retail investors, financial advisors, they don't understand how ETF market making works, liquidity works. Things like premium discount to NAV, you walk in, Friday morning, the Japanese ETF is trading, 50, 75 bip, expensive relative to NAV, and people don't know that, but they'll buy it. If we're living in a low return world, which all these market pundits keep arguing that returns are going to be lower, 50, 75 basis points actually can be substantial. And, look, the reality, Ed, is that most of the ETFs out there, bid offers are really wide on the screens, and I just worry about, the mom and dad investors that are buying that, e-liquid, kind of multi-factor ETF that, bid offer is really wide, and they don't understand how ETF creation, redemption work, and they don't have access to a liquidity provider to kind of give them a narrow, bid offer. So, the ETF liquidity is something that is what made it so successful, along with, their improvement in terms of taxes compared to mutual funds. But I feel like that also has been hindering, or could hinder, usage by, regular investors that just don't understand how the actual product works, or how to take advantage of it, or not be taken advantage of it.
Right. And that's, the limit order versus market order and all those things that people can get kind of sideways on with ETFs very quickly. This is when it came in. That probably Trey, since you spent so much time on the gold equity side as well. One of the questions also that came in is, what about M&A activity in gold miners? We clearly just saw a large allocation or a large transaction happen with Barrick. What are you seeing in the M&A market? The question specifically is M&A opportunity for gold miners, ? What are we seeing there?
Right. So most of the M&A that we have seen so far has been just been mergers. So, for example, we saw Randgold and Barrick looking to merge. That was done at a zero premium. So although Randgold is half the size of Barrick, Barrick is not paying up to acquire Randgold. Similarly, other M&A activities that we have seen where companies are actually bidding up and paying a premium to acquire a smaller company have been it's just been a share deal, because most of the companies don't have that strong balance sheet, and the companies that do have the strong balance sheet are happy spending the money on exploration on their own grounds. So as a result, most of the M&A has not really created any real value for investors and for shareholders of the companies that were being acquired. What would be more interesting and exciting to see is when the M&A starts to happen using cash, where companies are using their balance sheets to offer very high premium multiples or significant premium to for the companies that they're buying, and it's something we have not seen that yet. What I think we'll likely see is if gold prices remain depressed, if silver prices remain depressed, and precious metal equities valuations remain depressed, we'll probably see more portfolio transactions. So whereby we have seen Barrick do a deal with Zijin Mining not that long ago to sell a portion of their operations at Porgera in Papua New Guinea. It was just a portfolio transaction. We'll probably see more of that happening as some of the bigger guys look to right-size their operations and perhaps improve their balance sheet. However, when we start to see, as I said before, metal prices start to rise, cost of capital starts to come lower, as investor sentiment improves, that's when we'll likely begin to see the more splashy M&A deals that feature big premiums and real shareholder value creation, as opposed to just exchanging one security for another.
Yeah, and as I heard recently, the bigger guys are sort of getting their financial house in order in anticipation of that, to start making some acquisitions on the junior side, sort of lower costs, increase their operating margins, and build up some cash to make some of those purchases. So hopefully that's forthcoming. Natalie, how are we on time? Do we have time to take one final question?
Yes, absolutely.
Great. So we'll finish with this, which seems to be a question that comes up almost on every call I tend to do, but I think it's one worth mentioning. And that is, everyone wants to know about China, Russia, Turkey, India. What's going on there? They all just seem to be increasing their allocation to gold over the last decade. If you look at China or Russia, it's a factor of 3 or 4x. I'll throw this out there to both you, Sri or John. How important is the supply-demand side of different countries loading up on physical gold, whether it be China and Russia? Do you take that into consideration when you're looking at your overall allocation? I'll start with you, John, and then maybe Sri, you can end from a PM standpoint. How important really is that? But do you think about that at all, John?
Generally, we focus more on kind of, portfolio construction, diversifiers, uncorrelated assets, what's going on with the Fed, the economy, interest rates, yields. So that for us, that's challenging enough to focus on those attributes. So we have no other edge. Perhaps Sri does as more of like a true kind of, bottoms up, kind of person that lives and breathes gold all day long. But from our vantage point, we think at, things in terms of portfolio construction and big macro trends.
And Sri, how about you? I mean, do you take that into consideration? Are you aware of it? Does it really drive your decision at all, looking at what countries like China and India and Russia are doing?
Sure. So I'll just quickly add to John's final comment that he made about me breathing and living gold all day long. It's not very good for anyone's psychological health over the past 5 or 6 years, I'll tell you that. However, I mean, when you look at countries in particular, gold has to be, gold is usually stored. It's put into jewelry format or coins or bars or what have you. It is an investment. Most of the gold that has been mined is still above ground, and it is being used as a store of value. So when we look at individual countries and what they are doing with their gold reserves at the central bank level or on the retail level, it is important. But the more important overarching theme here is to see the size of the economy at play here, because if you're talking about a Russia, for example, Russia is not a very big economy compared to America, definitely, or even compared to China. So the total amount of gold consumption that can happen in Russia does not really move the needle as much as it would if it was China that we're talking about, or even India, which has traditionally been a very big consumer of gold. So when countries like China and India are doing well economically, this is where the love aspect of gold comes into play, because people buy gold jewelry for their spouses or their special someones. It definitely helps move the needle because the more physical metal that is taken off the market, the tighter the pricing becomes for anyone else looking to come in and establish a position, and it helps move the prices higher. So both China and India have really become bigger players over the past couple of decades in the gold space, and they don't seem to be going away from that. And I think as long as that trend persists, it will put gold in a relatively constructive space. And then when you have countries like Turkey, Russia, adding incrementally to the demand for gold, that is just another positive.
Well, thank you. And I think that's probably a good place to end the call today. And as Natalie said, for anyone who did not get to their questions, we'll be happy to reach out to you via email and or phone. And we certainly appreciate everyone's interest today. And to learn more about Sprott, you can visit us at Sprott, SPROTT.com, or call sales service desk at 888-622-1813. That concludes our call, and I thank you all for your interest and time.